Which platform do you usually invest on? CommSec, SelfWealth, or maybe eToro? Most people would name one of these, right? But if you're an ordinary investor who wants to reach financial freedom through long-term investing, the platform you should be using the most is not any of these. It is your Super. Yes, I'm talking about your Super account, the retirement fund that automatically receives a part of your salary every month. It might sound a bit counterintuitive, but in fact, Super is the most powerful long-term investment tool that ordinary investors can access. It not only helps you earn higher returns, but also saves you a large amount of tax. In this video, I will explain in detail why Super is the most effective way to invest for the long term. At the end of the video, I will also share a practical investment portfolio that you can apply directly within your Super to turn your long-term plan into action. So make sure to watch until the end, because if you're only buying ETFs on CommSec right now, you might be missing the chance to retire 10 years earlier. Before we start, I need to make it clear that this video is for educational and informational purposes only. It does not constitute financial or investment advice. Please consult a qualified financial advisor before making any investment decisions. The main reason Super should be your top choice is that it helps you save a huge amount of tax. Over time, the tax you save will compound, creating a massive difference in your final returns. Let's look at a simple example. Suppose you're 35 years old this year. Every year, you invest $10,000 into an ETF that earns an annual return of 7%, and you keep doing this for 30 years until you retire at 65. Now let's compare the results of investing through Super versus investing on CommSec or any other platform. If you invest through Super, that $10,000 will be taxed at 15% before it enters your account. This means $8,500 actually gets invested. With a 7% annual compound return, after 30 years, the total amount will grow to about $802,917. Out of this, $255,000 is your total contribution, and $547,917 is the capital gain. Since assets held in Super for more than 1 year qualify for a 1/3 capital gains tax discount, this gain is taxed at only 10%. So you'll pay around $54,792 in capital gains tax. In the end, your net balance at retirement will be about $748,125. Now let's see what happens if you invest the same amount from your post-tax income. If your personal income tax rate is 30%, then only $7,000 is left for investment each year. Over 30 years, your total contribution will be $210,000. With the same 7% annual return, your account will grow to about $661,226. The capital gain is $451,226. Because personal investments held for more than 1 year qualify for a 50% capital gains tax discount, your taxable capital gain is half of that, and your final capital gains tax will be about $67,684. This means your net balance after tax will be $593,542. In other words, under the exact same conditions, same amount, same ETF, same return rate, the Super investment ends up giving you $154,583 more than personal investing. If you contribute $30,000 per year, which is the personal contribution limit, the gap grows to about $460,000. This is the incredible power of combining tax benefits with the effect of compounding over time. Many people do not like using Super for investing because they think it is not flexible enough. Most people believe Super only lets you pick from a few preset options such as balanced, growth, or aggressive. They also feel they have no idea what assets are actually being invested in. By comparison, platforms like CommSec or SelfWealth seem more flexible. You can see your portfolio, trade anytime, and change positions whenever you want. It gives a stronger sense of control. But what many people still do not realize is that Super today is completely different from what it used to be. It has become much more flexible and much smarter. Take Australian Super as an example. It offers a feature called Member Direct. Through this feature, you could directly buy the ETFs or stocks you want inside your Super account. In other words, it works like a simplified version of a self-managed super fund. It keeps all the tax advantages of Super while giving you a high level of flexibility. For ordinary investors, this means you can enjoy the benefits of long-term compounding and low tax rates while still customizing your investments based on your own preferences. So the next question is, what should you invest in? I have shared this in a previous video. The best long-term portfolio for most investors is a 100% stock-based portfolio that comes from academic research and long-term data. It is simple and effective. 33% in your home country stock market and 67% in global stocks. In Australia, the two ETFs that match this structure are VS and VGS. Let's start with VS, which is the Vanguard Australian Shares ETF. It was launched on May 4, 2009, with an annual management fee of only 0.07%. It tracks the S&P ASX 300 index, which covers almost all of Australia's most representative and high-quality companies across key industries, such as finance, mining, energy, healthcare, and consumer goods. From a performance perspective, VS has delivered an average annual return of 10.06% over the past 10 years, 9.45% since inception, and 12.86% over the last 5 years. These results show that holding core Australian equities long-term remains a stable and reliable strategy. In addition, the Australian market has relatively high dividend yields, and VS has consistently paid steady distributions. It is a great fit for long-term investors who value stability and regular income. Now let's talk about VGS, which is the Vanguard MSCI International Shares ETF. It was launched on November 18, 2014, with an annual fee of 0.18%. It tracks the MSCI World ex-Australia Index, meaning it invests in developed markets outside Australia, such as the United States, Europe, Japan, and Canada. VGS holds more than 1,000 companies across sectors including technology, healthcare, industry, and consumer goods. It is highly diversified. Based on the latest data, its annualized return since inception is 13.71%. Over the past 10 years is 13.22%, and over the past 5 years is 16.33%. Together, these two ETFs form a strong combination. VS represents the Australian economy, while VGS represents global developed markets. Both have low cost, large scale, and high liquidity. When combined, they almost cover the entire global stock market. VS provides stable dividend income and exposure to Australia's economic cycles. VGS diversifies risk and enhances overall return through global exposure. Together, they create a simple, balanced, and steady portfolio that is ideal for long-term investors who want consistent growth with manageable volatility. However, a 100% stock portfolio does come with higher volatility. When a market drops, your portfolio value may fall quite a bit. For many people, the biggest problem in investing is not picking the wrong asset, but being unable to hold it through downturns. When the market corrects, they panic and sell, or sometimes have to sell due to personal reasons. If that happens at the bottom, the entire long-term strategy breaks down. This is where Super has a natural advantage. Because the money in your Super cannot be withdrawn before retirement, it automatically enforces a buy and hold strategy. It protects you from emotional reactions to short-term volatility and helps you stick with your plan over the long run. This structure matches perfectly with the long-term portfolio we just discussed. Super keeps you invested for the long term, while the VS and VGS combination drives your steady growth. Together, they provide both discipline and growth potential, which is the best way for ordinary investors to outperform the market cycle over time. To summarize, for most people, Super is not just a retirement account. It is actually your most tax-efficient, most disciplined, and most suitable account for long-term investing. By using it wisely, you can significantly increase your final returns without taking on extra risk. And with today's Super being much more flexible, investors can use features like Member Direct to build their own ETF portfolios without worrying about restrictions. Of course, if you have additional funds and want to invest in individual stocks or other assets that are not available in Super, you can still use platforms like CommSec or SelfWealth. But for most ordinary investors, Super is the one tool you should never overlook and should always prioritize. Every dollar of tax you save and every extra year of compounding will bring you closer to early retirement and financial freedom. So if you have not started using Super seriously for investing, now is the time to take action. If you found this video helpful, remember to like, comment, and share it with your friends who have not yet made good use of their Super. And do not forget to subscribe to my channel so you will not miss future videos. See you next time.